Very good evening, everybody. Welcome to the webinar, Economic Reopening and the Risk of Stagflation. I'm Ming Hui from Flip Nova, and speaking to us tonight will be Mr. Pua Lee Kirk, Chief Strategist at Phillip Research. Will we be hit by a U.S. recession before a complete recovery from a pandemic? What should investors do in this juncture? Before we hear all these from Mr. Pua, here is a quick reminder that if you have any questions throughout the course of the webinar, please feel free to drop them into the questions box as we will have a live Q&A session towards the end. And now, without further ado, let's have Mr. Pua speak to us.
Thank you, Ming Hui. Very good afternoon to all of you. As when I start the presentation, I will switch off the webcam to save the bandwidth. So I hope you can understand this part. And for today's topic, I put it as enjoying the reopening party, then with a stagflation sword, which means that whether stagflation is still the risk and whether can we not be the Democrats at all and enjoying a better economic growth path. And I will share with you some of my view and then zoom into a Malaysia market. Disclaimer is as usual. I mean, technically just saying that from now on, you don't have to believe in what I say. Now, let's look at the world. Of course, before we zoom into Malaysia, the global economy will still affect Malaysia. And when it affects Malaysian economy, of course, it will affect Malaysia market as well. So if we look at the world economy at this moment, of course, we know one of the risk factor is the Ukraine-Russian war, which is almost half a year already, and definitely is going to be prolonged, and it's going to be in a last situation. Now, why it can be prolonged? That is the part that you have looked into it, which means that the world economy, the market has to prepare that this can continue, right, for quite some time. Bear in mind that even US, when they have the war in Afghanistan, it was 2 years. So Russia, of course, can it afford to have such a long war? Definitely it's still not an issue, because if you look at Russia government situation, you can see that has been since 2001, Russia has been reducing its trade as a percent of GDP, because a lot of times the rest of the Western countries is talking about sanction so that Russia will have no fund to continue the war. But this is not true because they have been intentionally reducing their trade as a percent of GDP, which means that they can survive even if you sanction them. Of course, of late, you see that it has spiked up a little bit. Of course, major reason is they still continue able to export their oil and gas, which is still contributing them the war fund to a certain extent. And if you look at the fiscal balance, although now it's at about -4%, which is deficit, but again, with the money they have accumulated, and together you look at the right side, the foreign reserve is still stay at high, which means that Russia can still continue and it can endure. In fact, it is the other countries, the Western country, that may face the challenges if the war continue, because the rest of the Western country may face a high energy cost. Now, the next question is, of course, I mean, with the recent Nancy Pelosi case, and of course, some people is wondering whether China will start a war, or rather to say to unify or to unite Taiwan into China, the so-called One China policy. Again, if you look at China government situation, you can see that there is a similarity. First is that a trade as a percent of GDP has been coming off Of course, you can contribute part of it because of the COVID situation, but to a certain extent also, it implies that China was still able to survive even, they face sanction. And another part you look into it is that uh, the fiscal balance also they can still essentially running at deficit for a while because you look into it, it can also, still have enough foreign reserve. So in that context, of course, will China start a war? My personal view is that the current Taiwan situation, I don't think China are in the hurry, right? Sun Tzu art of war is from China, and the best way of winning the game is subdue the enemy without fighting. Of course, they are having the live military drill, but that is just to exert pressure on Taiwan because I wouldn't think that they will start any war until early or until after early 2024. Why 2024 is important? Because it will be the Taiwan presidential election. Because in between, depends on how China play the so-called information war game. If ultimately Taiwanese elected a pro-China president, then a lot of issues can be resolved. So I would say that the current tension, is not going to be a big issue like what we see in the Ukraine-Russia situation. And just to point out that because yesterday, I think a number of first, the China media actually has misunderstood the situation. And similarly, you see some of our local medias also with comments saying that because China sanctioned the export of sand to Taiwan, and therefore it may create another supply chain, especially on the semiconductor side, which actually is not true because if you look into it, the major, if you look at the semiconductor production process, you start off with sand, melt it, and then the silicon is manufactured into an ingot. From the ingot, you slice it, it becomes a pre-processed wafer. Then from the wafer, it only go to where TSMC process it. And of course, when they go to back end, some of our Malaysian company, example, MI Technovation, on the back end processing, and ultimately it becomes the chips that put into your handphone or your computer or cars or whatsoever electronic gadgets. So if you look at this part of it, right, the major supplier of a wafer, the pre-processed wafer to TSMC are essentially actually Japanese company and a Germany company. So the sanction of sand doesn't really affect the supply chain at all. So in fact, if the market, putting selling pressure on some of the tech stocks, it may be a good time actually to relook into it. Now, so with China and Russia, of course, I don't think China is going into war, but with Russia still continue its war in Ukraine, of course, it has already affected the world, and which has caused a higher commodity prices that bring US essentially technical recession. Although officially, US has not defined themselves into recession yet, right? But if you look at it another way, is that equity market has already, about 71% probability that US market is entering into a recession, looking at the current market volatility and the movement, whereas bond market is still not fully pricing it yet. On the other hand, economic indicators actually showing that that's why they say that not in official recession yet, because it's only 59% of the economic indicator is pointing that it may go into recession. So if you look into that, US in technical recession, what about number two economy? Because Malaysia can't be totally isolated from these two countries' economy activities. Now, for China, the headwind, where you see that the retail sales, it has spiked up a little bit, but it's not as strong. You can see that the trend is way down, is essentially due to the zero COVID strategy or zero COVID policy, which probably it can only be relaxed after the Communist Party Congress, which is either at the end of October or November. On the other hand, the rest of the world definitely is facing some inflationary pressure from China, because you look into it, for a while, actually China export price index, and from a macro perspective, actually is below its import price, which means that China companies are making or are losing money. But of late, you see that China companies, when they export their goods, they are able to transfer the price, which is definitely creating some inflationary pressure to the rest of the world. But China economy as a whole, I would say that, of course, it's still a positive growth, but anything below 5% to China is definitely a very slow economy, and definitely it will have some impact to Malaysia economy as well. So at the end of the day, I think you all have seen what IMF forecast was. I mean, it has been revised quite massively downwards, but it's still putting, even in 2023, it's still assuming that no country is in recession, which we keep our finger crossed, and hopefully they are right. Now, if you look at the current world situation, right, trade figures, you can see that the world trade figures on a year-on-year basis, you can see that the growth, of course, I mean, this is the pent-up demand, right, from the COVID, post-COVID. Now it has back to a more normal situation. And also, I use the word globalization is because it is slowly becomes deglobalized. It is a little bit slower pace, but it's getting into deglobalization, which ultimately, some country will benefit, some may not. Of course, Malaysia, I think, is quite well positioned to benefit from this globalization. Now, when we look at the economy, another factor, right, which one of the main topic here is stagflation. The keywords here is stagflation. So, how is the situation now? I mean, definitely everybody feel the pinch of the inflation, but will it throw the world into a stagflation? Let's look at the situation now. Now you can look into it. First, it is interesting, despite OPEC is not that aggressively increasing its production capacity or its output, right? But you can see that actually WTI, the US oil prices is coming down. So what it means is that US economy will see less inflationary pressure, but the rest of the world not necessarily true, which I will share with you in the subsequent slide. This slide is telling you that why US prices is crude oil prices and even petrol prices is coming down. This definitely will help to support partially the US consumer spending, because bear in mind that petrol is one of the big spending. So once the petrol prices come off, right, which means that they have more money to spend. Of course, you can say the other way is that, will that increase the inflation pressure? I would say not in the extreme situation, because of the oil prices has come down or petrol prices have come down. Of course, this one, at least I would say that for until end of the year, it should remain relatively at a more downtrend situation, not a massively downtrend, but at least on a more weaker trend. The reason is because the peak of the Americans, right, burning away the petrol is over. This is during the summer traveling season, which is over. That's why you can see that this year, right, the petrol demand is already coming off. That's another reason why the so-called petrol prices, and the petrol station is also coming off. Now, like I say, US may start to see a much acceptable petrol prices, right? Of course, it's not going to back to normal because as long as the Russia-Ukraine war continues, which it will continue because Russia can afford it, but you can see that US WTI versus the OPEC, right, basket price, you can see that there's a premium on the OPEC price, whereas US is coming off already, right? Of course, the major reason, one of it, despite, although there are some argument that US petrol producer, the homeland petrol producer are not that keen in increasing the output, but technically you can see that there's a spread here. You can see the premium, the war premium, the rest of the world are paying. Actually now it's about $12 per barrel. I would say that it probably somewhere it will normalize back to around $10, which means that the rest of the world is going to pay a $10 premium compared to what the Americans are paying. So which means that US inflation pressure may start to ease off, but it's not going to back to what you see in the pre-COVID level, but the rest of the world are still struggling to see how to absorb this inflationary pressure from the oil prices. Although, yes, it has come off, but it's still, right? You are seeing a higher price, right, compared to like America. And of course, the worst is for European countries, where because of Russia, right, are tightening that tape or that pipeline, supplying the natural gas to Europe, prices has gone up. So Europe was still, facing inflationary pressure until where the economy really slow down and demand is weak, right? In terms of food side, and we all know the agriculture and in terms of food, Ukraine has managed ultimately, Russia also agreed onto that, to allow Ukraine to export the corn and wheat, which actually essentially will ease off some of the food inflation pressure, right? You can see that actually, again, from the US perspective, fertilizer prices has already started to ease off, and you can see that the link, excluding Europe side, probably the natural gas may start to come off a little bit, which also will bring down part of the fertilizer prices. But it's not going to back to where it used to be, right? But at least you see some inflationary pressure start to ease off, right? So if you relook into the fertilizer and the World Food Price Index, right, it is very highly correlated. So long as the fertilizer prices start to come down, at least not continue to go up, then at least there is a breathing space for the rest of the world, especially for the emerging countries. Now, will the commodities, the agriculture commodities prices continue to go up? Of course, again, I have to use some accountant phrases of barring unforeseen abnormal weathers, which sometimes now it becomes a norm. Probably I see some picking up until end of this year. Reason is because China has already stocked up enough some of the major crops like corn. China accounting for 65% of the world inventory, wheat 52%. I don't think they need to stock up that much anymore, especially, if we believe that they are not going to have a war with Taiwan, right? Rice also, China has stocked up about 60% of the world inventory, and soybean is about 30%. So you can see all in all, probably China is unlikely to continue, right, to fight for this type of crops and then jack up the world commodity prices. So you can see that the war premium still there, but it start to come off, right? Whether in terms of agriculture, in terms of the energy, which is oil, and then in terms of the minerals, which is base metals, essentially it start to come off. But like I say, don't expect it to back to the normal level, but at least inflation may start to pick up. And you can see also the logistic costs, right? Especially international logistic costs like the Baltic Dry Index, right? The ship that carrying, whether it's coals, uh, iron ore, or crops, and all this has start to come off, right? It's still not back to the low level, but at least it's off from the high peak, right? Uh, Similarly, you look at the normal container freight cost also has been coming off. And if you look at the correlation between US CPI, it's a matter of time that it start to pick out. And that's where US may not continue to see a so-called rising inflationary pressure. As for Malaysia, also relatively, but here because our petrol is subsidized by the government, so we see less, inflation pressure and less correlation during this period of time. So, with all this in mind, I would think that the FOMC will not become more hawkish anymore, which means that it will go along, right, what it has been planning, right? The next meeting, probably 50 bips, subsequently 25 bips until February next year, totally bring the Fed fund rate at the upper end, upper limit to 3.75. So long as they don't turn more hawkish, equity market is not going to have a negative surprise that causing the market to fall. So, just to recap, US economy, we think that it's still doing all right, although it is in a technical recession. But the major reason is because you look into it that the labor participation rate, especially when you see that the blacks are start coming back into the job market, and it's very clear when the blacks come in, normally they'll spend based on the revolving credit. That means a revolving credit card. Of course, the argument is, will that bring into a higher risk? At this moment, the answer is I don't think so. When I say I don't think so, because they know that they are entering into a higher interest rate environment. So we don't expect to have some excessive spending because of that. So in that context, I think consumer spending still continue. So what it means is that US, if you look at the bond market, you look at the yield, it is technically factoring in a recession. Of course, technical recession is there already, but the actual weaker economy indicator that point to recession, we think that it's very likely, if it happens, is early next year. Now, will US go into stagflation? Right? Recession, probably yes, but will it go into stagflation? Now, the answer, you look into it, we have a so-called disaster index, which is a combination of the unemployment and also inflation. The highlighted in yellow are the period of so-called stagflation, which is during the 1970s, the oil shock period. You can see that essentially, when the disaster index, right, rise above, this is inverted, so it comes down, means it rise above 10 or greater than 10 or 10%, right? First is definitely US will go into recession, but will it go into the stagflation? You only see this period of time. Why this round? I think maybe not. It's because the unemployment rate is still very low, right? This above 10 is essentially contributed by the higher inflation, which is probably going to be start to pick out, over the next few months. So in that context, we may able to avoid a stagflation. So with this in mind, how is Malaysia, right? Again, like economy, market is an indicator of economy. So whether we are, with a very, very unclear situation, or it's going to be a sunny situation for Malaysia. Let's look at some of the indicators. Our industrial production has been holding quite well, right? It's still showing growth, although, again, the pent-up demand will come off a little bit. So long as it stay around this level, I would say that our growth path is still, very sustainable. Of course, some of you may argue that one of the main factor is because we benefited from the for a while, the higher CPO price and for now it's still relatively high crude oil prices. But if you look at the output on the mining side, right, it's not that strong, right? We are still essentially manufacturing, supported by the manufacturing, right? So if you look on the year-on-year basis, this is just an indicator taking 2015 as 100. If you look at the year-on-year percentage change basis, you can see that, right, it is more normalized compared to this situation, right? And the weaker mining sector, which include the petrol, crude oil, and all these, are also not that bad because there is a strong spike up here, mind you. So all in all, our industrial production actually points to Malaysia economy is still on a gradually recovery and sustainable growth path. And if you look at our export, right, export has been a very important to our economy. And you can see that to the major countries, whether to EU, Europe, EU, US, right, Japan, and even China, right, is still showing quite a normal positive growth path, right, compared to historically, right? So, and if you look into it by products basis, you can see that, of course, one of the major contributor is petroleum, right? That is for sure. But if you look into others, I mean, palm oil has come up a little bit. The rest are more on a normal trend, which is about plus 7-8% type of growth, which is, it's neither overheated or is going off and coming down. It's not. So we are from the external factor, so long as US does not fall into recession, China still can maintain the growth path of at least around 4 to 5%. We will be doing quite all right, especially because we come out from a low base on the reopening of the economy. So we will be doing all right. And then in terms of service sector, of course, this one year on year is not a reference at all, right? On the inbound tourism, we are still at a very low. But as we start gradually reopening, right, we can expect, especially towards the year-end season, probably more tourists, inbound tourists coming into Malaysia, which means that essentially this is another positive factor to the Malaysia economy. And for this reason, that's why the consumer sentiment, despite that there is some inflationary pressure, right? The consumer sentiment is still relatively positive, right? It's still above 100. It's still above 100, So this means that actually, like I say, for the consumer spending is still, not to say super strong because there's some pent-up demand, but it's still within, right, relatively sustainable situation, right? If you look into it, you can see very clear that motor vehicle seems to be a bit sideways because essentially that due to the chip shortage and all this, a number of cars or models have a long waiting time. But if you look into the retail sales, you can see that it's still on the uptrend. On the wholesale trade, it's also on the uptrend. That means the consumer and spending are still quite all right, right? You look into it, you can see, of course, one, you can argue that, which is definitely not easy to capture in terms of actual economy because a lot of consumer spending, I mean, Malaysian favorite of a mama store and a pasar malam type of, you can see is still very strong. Then, of course, another one is unfortunately because petrol prices, despite government subsidizing why petrol prices spend is high because people start to move around. So all this actually is telling you that Malaysians still have money to spend, right? Of course, you can see that recreation, of course, we have the festive season of Hari Raya. So there's a spike up here. So now it's back to normal, but towards the year end, I think you can see that, it will coming back again, right? And you can see that, of course, there is some inflationary cost here, but grocery, pharmacy, right? Of late, of course, if you go to pharmacy, you can see a lot of people queuing up to buy the antigen or RTK test kit lah. But what I'm trying to say is the spending on grocery, right, are still relatively sustainable. And you look into by state, by the major state, which like KL, right, you can see that spending on grocery is still very strong. Although retails is not to say super strong. One of the factor is because some are start getting used to the internet shopping, which is not captured in this statistic yet. Huh? So Selangor, same thing. You can see that spending on grocery is still strong. Be it Penang, Johor, all are the same. Okay, I mean the mobility, which means that spending is there, right? So like I say, why? Although a lot of time people say that, okay, Malaysia household debt as a percent of GDP, actually you look at the number, you say it's scary, right? This is only up to second half of last year. It's 89% of GDP. But there's another side of the story that has never been highlighted, is that the household liquid financial asset, right, as a percent of the household debt, actually it's 144%, which means that Malaysia are not so-called in the financial term, are not in the negative equity situation, right? Not in the negative shareholder fund, so to speak. There is still financial assets that in case, they need to pay down for whatever reason, there is still a room there. Of course, you can argue that this is a macro, but there are some people who are actually, facing a financial stress. But when you look at the totality, which also tells you that economy is not going to be as bad as what you just look at this number, right? And from the banking perspective, you can see that the impaired loans ratio in the household sector is only 0.7, right? It's only 0.7%, which is very low at this moment. So in terms of end consumer spending, I think we are still remaining quite all right, right? What about in the business side? You can see that business confidence also relatively is still quite all right, right? Getting more positive. And this is the period during the recession. I mean, the COVID recession, you can see that business sentiment has dropped, right? Has dropped below zero. And you can see that actually it do have some correlation with the OECD composite leading indicator, which has come off a little bit. But essentially, again, with US, I don't expect that US going into stagflation, which means that the whole world economy is not going into a very bad tailspin, right? Slower growth, yes, but into a totally stagflation situation, maybe not. And you look at Malaysia quarterly GDP, right, which is quite related with the business sentiment, which so long as continue to remain relatively positive, I think we still able to grow our economy, right? And interestingly, again, from the financial stress perspective, you can see that the business sector, the operating margin has been improving. And then the interest coverage ratio, right, is also quite healthy. It's 7.5 times. And then the impaired loans, right, which is also relatively stable, which means that the whole financial system, first, we are not going into a stress, and it won't stress the banking system as well, right? So with these private sectors, be it consumer or business sector, seems to be able still to sustain its growth. What about government? Because government sector is where will determine whether so-called foreign fund will flow in or not. Yes, the number is not that good in a sense that our debt, right, plus government guarantees is about 83.5% of GDP. Of course, excluding guarantee, essentially is still kept below 65%, right? Our debt service alone, right, cost government 43 billion, right, up to date. And definitely because of fuel subsidy at this moment, government has to spend about 28 billion this year, right, to cap the fuel price, the petrol price low, except for the RON 97. And similarly for the electricity, where that's why our fiscal deficit this year, right, is unlikely to improve, right? And because of that, although Bank Negara has already raised interest rate twice, but the interest rate differential has caused some foreign fund, foreign money, not only the portfolio investments, but some of the foreign money also flowing out. So our reserve has been coming down, but it's not at the alarming level. Why I say so? Okay, because there are a lot of news, there are a lot of people talking about, will Malaysia be the next Sri Lanka? At this moment, the answer is no. When we look at all these indicators, be it the foreign reserve, right, as a number of months of your import, and then your short-term external debt, right, as a percent of your import, your foreign reserve to your short-term external debt, and then your broad money base to foreign reserve, and your real short-term rate together with your fiscal and current account. Normally, you can see that if you have, right, 5 out of 6, then you are in trouble, right? This is where Sri Lanka, and this, if you continue for quite a few years. But if you like Malaysia, well, I mean, we are not in the flying colors league, but neither we are in the disaster group. So we are still okay. We are still okay, right? We are still okay. Of course, this will continue to be monitored, but at least I think for the next 1-2 years, it shouldn't be an issue. So will Malaysia go into stagflation? I think it's also very unlikely because you look at the disaster indicator, right? During even the recession, the COVID recession, it has never fall below or fall above 10, because it's inverted. One of the reasons is because our unemployment rate is still low. On the other hand, the key inflationary factor at this moment, which is fuel prices, right, it's been subsidized by the government. So we are probably, like say, if you combine all this, business sector still doing all right, exports still okay, consumer spending still okay. So all in all, our economy at this moment are still quite all right. It's not going to be very strong, right? This year probably about 5.3%, next year maybe 5%, but it's not in a disaster situation, right? Fiscal deficit minus 6.2, next year probably minus 6, and interest rate probably by end of the year, we reach 2.5 and it should be stay there. Right? Ringgit this year, yeah, a little bit weak. Now it's lower than 4. I mean, against US dollar, it's more than 4.5. But we will foresee that it probably will get normalized back by next year. And interest rate, you look at the government bond yield, you can see that the yield curve has started to back to a more normal situation. So the most important part, what does this mean to the equity market? Again, when we look at equity market, we can't ignore US. This table, just to show you, I mean, the interest rate, the rate hike, I think is more or less no surprise. And then the key part is the quantitative tightening, which is technically expected is essentially from September onwards, it will be 95 billion almost every month, start reducing it. So there are worries that because of less liquidity, we all know that during the COVID period, market has run into a little bit overheated situation because of the excess liquidity. So what does that mean? Of course, when it's coming off, right, there is some coming off. You can see that it's very clear. When liquidity start to reduce, right, market will come off a little bit. But I think that's where it is. It affects a little bit more on the commodity sides because this more speculative situation going in there, right? So having said that, so the market will become less speculative, which actually is not a bad news, right? And of course, to a certain extent, for those of you who trade share, you know that probably it's not as easy as in the past to get margin, right, to trade, which also will bring the market down a little bit. But once this stabilize, right, the market will relook into the growth path and probably will start to back on the uptrend again, right? And like I say, despite of quantitative tightening, right, interest rate hike and all this, you can see that, there is still liquidity in the market, right? Not excessive. US one is still, take some time. You look at Malaysia, right? It has been steadily rising, right? So there is still liquidity, whether in Japan, in EU, in Japan, the liquidity is not as excessive in US. So it doesn't mean that the money will suddenly dry up and therefore you see a big correction in the asset prices. As far as liquidity, right? Liquidity context, it is not likely to be happen into a big dry up that ultimately force the market to collapse, right? And even though liquidity start to reduce, like I say, still there. So you look into whether it is a US, other advanced economy or emerging markets, the financial stress indicator, right, indicate that actually it's not really under stress yet. So the worry of a financial crisis, at least until end of this year, I don't think you need to worry about it. So with all this, what does that mean, right? Malaysia market, no matter how, I mean, what it means that US market will see some, which already come off a little bit, now start to see some rebound. I mean, Malaysia market to a certain extent will be affected. I mean, we can't run away by the US market, which means that volatility will be affected by the US market volatility, right? Where we have correlation, right? Since, although since 2020, it's a much lower correlation, but all in all, we still positively correlated with the US market. So long as US market doesn't go into a big correction, Malaysia equity market should be quite all right. Right? Like I say, it's not that disastrous. You look at the disaster indicator. So US market is not going to be that bad. And if you look at VIX, it has come off a little bit, although the bond move index has recently just spiked up a little bit, but this probably is just a short-term volatility, right? And on top of that, if you look at the just announced second quarter earnings, it's not that bad. In fact, right, EPS, the earnings per share for the S&P 500 as a whole is still on a growth path. And for Nasdaq also, actually a lot of analysts start to revise up the earnings. So that's why you see Nasdaq market start to rebound as well. So all this means that actually it's positive for US market, which ultimately is also positive for Malaysian market. Because bearing in mind that yes, US in technical recession, but the actual recession, American definition probably is next year, and it's going to be a relatively quite short and mild. Then market, you start see actually instead of earnings revised down, it's more of earnings revised up, though not massively up, but it's still a positive indicator. And you can see that foreign funds start to come into Malaysian market as well. This is the clearest you can see that, right? Since last month, right, foreign fund, the darker blue line, right, is on the uptrend. Of course, day to day, you have some volatility, and that also brings our index up as well. So even then, foreign holding is still low at 20.6%, which means that there's still room for them to come in. And if they come in, of course, market will see some uptrend. Then the next question is election. When will we have our GE15? Now, this one is anybody guess, right? I mean, technically, it's all up to our prime minister. But if you look at historically, right, generally, market will run, but it's not that strong. I mean, on average, it's about 2%, right? 6 months, 6 months, 3 months to the election, right? It will move up. It will be on uptrend, but it's not to say super strong. Then after that, it really depends on the result, but most of the time it's more towards marginally down. Now, if we look at our market movement now, if you assume that election is in September, this is where we are. If you assume that election is in December, this is where we are. When we take all these factors in, and also considering that the budget 2023 is tentatively to be announced on 28th of October. So if you take all this in, the window period for Prime Minister to call for election within this year is very limited, because bear in mind that if you call an election after announcing of the budget, before the parliament can have a first, second, and third reading to pass it, then it will become void, which does not make sense. So what about election in September? But bear in mind that 16 September is our Malaysia Day. I don't think Prime Minister want to be a caretaker Prime Minister, right, to celebrate the Malaysia Day. So which means that the window period probably is after Malaysia Day, before the budget. Of course, budget they can delay it a little bit, right? And of course, if that being the case, how they are going to give out candies and is $1 million question. But if there is an election, probably it's around this period. If that is being the case, maybe the CI can hit 1,571 points, right? Which is about another 5% upside from here only. It's not to say unachievable if they want to call it, right? I mean, if assuming that there is an election, right? Now, on the Taiwan crisis, or rather to say the current Taiwan-China tension, right? We do not see that there is any significant to the market, because if you look into 1995, where China threatened to launch missile, and some actually launched missile for the drill, right? During this 1995, which they did it twice, 18th of July and then 10th of August. Actually, at that point of time, CI dropped 3% and 5%. So it's not a big deal at all, right? And you see there's a lag here because at that time it's not really a social media internet age. So Malaysian market behaved a little bit slower than the US market. Then in 1996, right, you also see another round, which is March 1996, where, you know, China said they want to launch missile, right? So of course, market collapse. Whether you call it market collapse, at this point, CI fell a little bit more, 10%, right? Whereas S&P 4%. So even you take all this into situation, right? You don't expect it to see a big correction like what you see during at the very beginning of the COVID or the Ukraine-Russia war, right? And immediately you can see it's rebounded, right? Because there's no war, right? It's just some verbal tension. After that, market just rebounded, and actually it go into the higher than before this announcement, right? What about the Ukraine war? I think market has already fully discounted it, right? So we can, to a certain extent, ignore about the impact of Ukraine war from now onwards, at least for a while, until Russia start to have another operation, or another strong war strategy against Ukraine. Then what about the interest rate environment? Right, in the rising interest rate, S&P has already started to move up. Like I say, we are also affected by US market. So you can see that the last round, we don't see any correlation, but market do behave together with the S&P 500 US market as well. So if you look into all this, it tells you that the downside risk to the market is relatively minimal, right? Although there's still some uncertainty, but we do not think that we'll go into a recession, or sorry, into stagflation. So we put it that our standard base case scenario for the KLCI at year end is 1541, right? In the best case scenario, we may even go up to 1629. Worst case, it may look very low, right? 1356, 20% chance. This is assuming that US market, right, correction during the recession, right, since 2000, it fell 45% on average. So if this happen, yes, then our market may go to 1356. But I think this also has a very low probability at this moment, at least not until year end this year. So because of time, I will skip on each sector outlook, but most of the time, most of the sector currently we still remain neutral, except that we underweight on the glove sector and overweight on the telcos. Now, if we talk about the risk, of course, still nobody knows, but we think that the risk of global recession is low. But abnormal weather, yes, it can affect inflation. And if China continue zero COVID strategy, it may also slow down the global economy than what we are looking at now. Geopolitical risk, well, like I say, I don't think. I mean, you may have tension, but I don't think it will go as far as Asia Pacific is concerned. I don't think it will be a war at this moment, right? I would say that not until after the 2024 Taiwan presidential election. For Malaysia market, of course, domestic political uncertainty, when the government will call the election, will the prime minister being forced to call with, and the budget becomes void, without 3 readings passed. And then at this moment, like I say, this one is not that high because when we compare to Sri Lanka, right, we are not to that situation. So sovereign downgrade on Malaysia is not that high. So all in all, we maintain our base case scenario. The only one risk next year, I would want to say, the black swan is the solar flare. You can see that whenever there's a strong solar flare, this is US market, right? It will fall because sometimes it has affected communication, it affects the power sector. So next year onwards seem to have some strong solar flare, which may cause some unwanted downside risk over a short-term period, but that's what it is. We can just only keep an eye and monitor on it. So against this background, what are the picks that currently we are looking at? Right, in terms of fundamentals, we like Burma's auto because it is in its special segment where the buyers, are not that influenced by the economy situation, because these are the so-called middle upper income layer, which is still quite all right. Then we like Guangzhou. This is technically a global consumer relatively stable spending, and especially like Europe, when they start to expand the market in, and European, you know that they consume a lot of chocolates, which will put Guangzhou in a very good position, right? On the short term, although it's until year end, on a technical side, we think Genting Malaysia, because it does not, unlike Genting, it does not own the Las Vegas, which is still quite not fully recovered yet. And of course, if China start to relax its zero COVID policy and Chinese tourists still come to Malaysia, of course, Genting will be definitely the beneficiary. That's the reason why it runs up in the early part of this year, then come off again, right? IHH, of course, with the reopening, medical tourism will start to come back again. So this is where we focus on this company as well. Kawan Food, again, on the frozen food, which is, if you can see that the grocery spending and all this still remain quite strong, and they are able to pass some of the cost over. So this is why we think that it's worth of looking at, right? Matrix concept, You may say that property companies, why you look into that, but this is a very unique position property company where it provides township in Seremban, catering for the Klang Valley middle income group. So it's a very stable company as well, right? Telecom, well, I mean, it's just one of the big company. When foreign fund coming in, probably you'll see some attention to it as well, right? And of course, some of you may aware that actually you can trade ETF in a Bursa exchange. There are two ETF currently. We think that there's some upside potential. It's actually both are Southeast Asia or ASEAN market ETF. One is just an Islamic dividend. Another one is ASEAN 40, right? With the reopening of the economy, and if you want to have exposure on the ASEAN country without going into individual ASEAN stock in your portfolio, these are the things that you may want to consider. Now, this one, we have not seriously looked into it yet, but if you look at TSMC, no, I'm not recommending TSMC nor Hong Hai, but what I'm saying is that if you look at the orders of TSMC, right, at the Hong Hai, you can see that most of the time, during June period, it has been weak, but this year is strong. It's an indication that Apple probably is expecting a better sales this year. And essentially, when you look at the inventory turnover and all this, right, both TSMC and Hong Hai, looks like the tech sector, there are a lot of things talk about tech sector, whether the cycle is downturn or not, but short-term indicators telling you that it's still all right. So if you want to speculate, right, this may be the sector, the company you may want to look at it. One is MI Technovation, another one is Chronology. Okay, so with this, thank you very much, and I pass the floor back to Ming Hui.
Okay, thank you, Mr. Phua. Moving on to our Q&A segment. The first question for the night is, you may have briefly touched on this earlier, but do you see any similarities between the current situation and the 1997 financial crisis?
Okay, I wouldn't say there is a similarity at this moment. The reason is that if you look into it, this round, unfortunately, well, I'm not sure whether I should use the word unfortunate because I didn't put up other countries in terms of the financial indicator, right? I only put Sri Lanka as a comparison. Actually, other ASEAN countries are relatively, some of them actually are better than Malaysia. Malaysia, like I say, definitely is not a star performer at all, right? A lot of situation happens in the so-called frontier economy, not the emerging countries like Malaysia, Thailand, Philippines, or Indonesia this round. So to a certain extent, I wouldn't see that there is a big financial crisis happening. Even assuming that, let's say, inflation pressure remain high, there are unrest in frontier economy, the spillover to the emerging countries and ultimately to the developed countries is still very low at this moment. That's why if you look at the financial stress, right? Financial stress is over here. Yeah, this one, right? You can see that emerging economy, are still not that bad. So I wouldn't think that there is likely to be a recurring of the Asian financial crisis. Okay.
Okay, thank you for your answer. The next question is, what does solar flare mean?
Sorry?
What does solar
Oh,
flare?
solar flare. Okay. Solar flare is essentially, I mean, you know that the sun has a lot of activities. Solar flare means that it's like the flame is shooting out from the sun surface, and when it starts to shooting out, essentially it creates electromagnetic wave that can cause blackout in some of the countries. I mean, actually, Canada experienced one blackout due to solar flare. And if a solar flare is serious enough, because there's a radiation, it can affect the satellite, which ultimately affect the telecommunication, which ultimately affect the business activities and even on the share trading. So this is something that we have to monitor. I mean, scientists also can't predict when which day the solar flare will happen, but they are seeing that there is an increasing chance that solar flare will getting more so-called serious uh, in the 2023 to 2025, these 3 years.
Okay, got it. Thank you for your answer. The next question is between the US and the China markets, which will perform better within the next 12 months? And how about the technology sector?
Okay, between US and China, I think it's two very different market to a certain extent. I mean, we actually looking China market is on the uptrend momentum, except that the policy uncertainty still remain until the party congress is over. So from now until then, you may see volatility, and then after that, whether the policy is going to be market friendly or not is something we have yet to see. So in that context, we see uptrend momentum, but it's still relatively volatile. Now, for US market, I think the market is more or less like I show is about 70%. The equity market already pricing in a recession. So if we take that, so long as FOMC doesn't become more hawkish, so long as it's still along the path, like what Powell has mentioned during his last press conference, then for the market, actually you have less surprise, and that's why it still also continue, not a super momentum, but the uptrend momentum is still there. Whereas on the tech sector, you can see that again, the earnings is being revised up. That's why it's going up at this moment. Of course, you have to see the next quarter, how is the earnings coming out. But of course, that's why I say it's a Christmas present for the tech sector. You have to monitor. So it's more towards a short-term trading type of situation at this moment. Of course, for investors who buy for long-term, technically tech is still a growth sector, right? Over long-term, like 3 to 5 years, there should be. I mean, it should be on the. It should have upside potential.
Okay, thank you for your answer. The next question is what is your opinion on the China property crisis and its global impact?
Okay, China property crisis, I mean, if you look at Evergrande and all this, it does not really impact first on the equity market. It does have some impact on the bond market, but it also does not have a big spillover at this moment. And then the China property market, essentially, there are two reasons on that. One is that it's beyond the affordable level to a lot of mainland Chinese people. Secondly, there is some excess supply as well. So that's why originally Xi Jinping advocated to make it affordable. That's why you see this current property slump. And this probably will continue for a while. Like I say, until the party congress is over and see what is the policy that Xi Jinping is going to pursue. If he still insists on normalizing property prices, then the market will still remain bad for at least until middle of next year.
Thank you for your answer. The next question is do you think the current rebound in Wall Street still has legs and that we have already hit the low in June this year?
Uh, okay, short term wise, yes. Now the question is how far the market has discounted. I mean, normally we say market looking, I mean, discount the economy 6 months ahead, right? But this round, it seems that they already even discounted into the early next year recession. If that being the case, then the upward momentum can continue until probably first quarter of next year.
Okay, thank you for your answer. The next question is, what do you think the impact of COVID-19 will be on the markets worldwide for the next 3 to 5 years?
Okay, I mean the impact that we experienced over the last 2 years, like I say, one is the deglobalization, right? Deglobalization. So you'll see that there will be more and more uh, companies, and this include China company as well, provided that Xi Jinping doesn't prohibit them to get out. Like before that, China has been encouraging their companies to go overseas. So what it means is that a lot of companies will start to have their production base or their supply chain nearer to where the end demand is. So like, for example, there are so many in China catering not only China, but also to export. So some of those that meant for export may start to leave. Let's say, uh, for example, I mean, Tesla is not doing that. I mean, let's say we take extreme example case. Tesla did, I mean, does do some export from China. So that part, they may shift it out, but the market, the the factory, right, will still cater for China domestic demand. So what I'm trying to say is that essentially, uh, you will see there is a reshuffling of the supply chain. So some countries will benefit, some may not, right? Of course, within the countries that may benefit is like India, Southeast Asian country, including Malaysia. I mean, depends on which uh, part of the supply chain you are in, right? But definitely you will see some positive impact on that. Then, of course, I mean, countries in Europe, especially the Eastern Europe country, and then some in the Latin America.
All right, thank you for your answer. The next question is, do you think there will be a black swan event in the Malaysian market?
I don't know whether this is recorded. Uh, I mean, whether is it I mean, okay, let me cite example. You know that your your founding father, when he passed away, I mean, I wouldn't call it black swan, but you know, it moved the market, it moved the country, it moved the election votes as well. So you know what I mean, huh? So I mean, if you ask me black swan, which means that this is what it is, right? If he forget how to open his eye anymore. But I don't think it's going to be a very negative impact onto the market.
Okay, thank you, Mr. Phua. We will pick this next question as our last for the night due to time constraint. So we have a member on the audience curious on why you use the US statistics as benchmark to illustrate your presentation in comparison to China, who is the world's manufacturing nation.
Okay. First is that even why US is because if you look into it at this moment, we look at the next until end of the year, US is the economy, is a country where the economy has stuck back to normal. whereas China is still having a zero COVID policy. So that actually has caused the economy not back to its normal trend. So anything that will support the rest of the world economy were highly dependent on US. Even China itself, because they need to export, right? So on the other hand, right, if China pursue a zero COVID policy and suddenly have a lockdown for 1-2 months, it will mess up the supply chain, it mess up the US economy, everything gets messed up as well. So when we look at where the growth come from at this moment, it is from US. Europe now, because of having they are the nearest to the Ukraine-Russia war and are still struggling on how to find gas supply from elsewhere. So that is not likely to drive the world economy. And Japan is not yet. Definitely is not. So unfortunately, we are left with US at this moment.
Great. Thank you for the insightful session tonight, Mr. Phua. We will conclude today's webinar here due to the time constraint. If anyone else has any further questions for Mr. Phua, you may send them to us via the survey that will appear at the end of the session. And we'll also be sending everyone a link to today's webinar recording so you can watch it again if you'd like to. That's all for today. Thank you again, Mr. Phua. Also, thank you everyone for your time tuning into this webinar tonight. We will see you at our next webinar session. Have a good night.